So today we're talking about the history of the stock market. And if you look at some stock market charts or you study the stock market history, you're going to realize and see that it always goes up, at least in the United States. So I'm not talking about other foreign markets and stuff, but in the United States, it's continued to go up, over the last 100 years. If you look at the stock market charts as far as the indexes, the S&P 500 index, the NASDAQ index, and the Dow Jones index. It's gone up and up and up and up for 100 years. So check out those charts, and you will see that that's what it does. And then we also can look at the history of drawdowns. So drawdowns is when the stock market drops, 10%, or it drops 20%, 15%, 50%, whatever percent. The history of drawdowns is, every year the stock market usually has a drawdown of 5%. Every 2 years, the stock market has a drawdown of 10%. And every 5 years, the stock market has a drawdown of 20%. And that's 30 years worth of data showing that every year we get a 5% drawdown, and then every 2 years we get a 10% drawdown, and every 5 years we get the 20% drawdown. Now, if we look at the most recent history, we're doing far better on the drawdowns. So that makes me excited, because the future, that means we're probably going to have maybe less of them. I can't predict the future, but because of the history of the drawdowns recently, it's most likely that we're going to have some pretty good momentum going up. So back in 2018, the first part of 2018, we had a 10% drawdown. And then the end of 2018, we had a 20% drawdown. And then 2019 was pretty good. It went up like all year, 20%. And then earlier this year in 2020, it dropped like 36% or 37%. So as far as the history of the stock market, we're definitely beating the drawdown as far as how often it happens. So that makes me excited, like I mentioned, that it's potentially going to continue to go up. So right now, the end of 2020, it is down again 10%. It may go down 15%, 20%. Like, I don't know. Nobody can predict what the stock market is going to do before it happens. But the way I buy is I buy, when it drops 5%, I buy a little bit. When it drops 10%, I buy a little bit more. When it drops 15%, I buy more. When it drops 20%, I buy more. When it drops 25%, I buy more. When it drops 30%, I buy more. So I'm always buying as it goes down. And then when it goes up, I usually just ride the wave. I ride the wave. I'm a long-term investor. I'm going to hold on to it forever. And you can look at the track record and see that that's probably the best way to invest as far as you. The other part of understanding why it's always going to go up is the Federal Reserve, and understanding what the Federal Reserve has been doing since they were created back in the early 1900s. They are going to make inflation happen. So if you go look at what they've been doing since the 2008-2009 financial crisis, is they've expanded their balance sheet, and they continue to print money. So just go to Google search now, or as soon as the video's over, and you can search for Fred, and then Fed, Fred, and Fed balance sheet, and that will show you it's up to like 7 trillion, maybe 8 trillion. I can't remember exactly where it's at, but last time I thought I saw it was at 7+ trillion. So probably by the end of this year, could be at 8 trillion. In the next couple of years, they're buying, I think it's 60 billion a month in treasuries right now, and they're buying I think 30 or 40 billion in mortgage-backed securities. So it's just creating tons and tons of liquidity, money into our economy, causing inflation, causing asset price appreciation. So housing prices are always going to go up, stock market prices are always going to go up, and the Fed doesn't care. The Fed wants it to happen. They need it to happen. It's almost like a matter of national security for our country, for the stock market to always go up, for the housing market to always go up, because it's the fundamental. It's kind of how our society is structured. Some of the fundamentals of our society need the prices to keep going up, or it doesn't work. And I guess some reasons why that is look at all the pension funds that people have out there. They're all based off the stock market continuing to go up. Half of all Americans, 50%, have a 401k. What's a 401k invested in? The stock market. So if it goes up, they can do okay, they continue to survive. If it goes down, it's like a national security crisis. So they definitely need inflation, asset price inflation. They need things to continue to go up forever, so it's going to happen. They don't care if their balance sheet goes to 100,000, $100 trillion. They don't care if it goes to 100 trillion. It will go there. Just wait. And then another main thing about understanding the stock market is don't listen to the mainstream media people. They get you to take too much action. So they get you to buy and sell and buy and sell and buy and sell. It's too much action. Where if you look at the history, it continues to always go up. So if you just buy an index fund, I'm not talking about an individual stock, but an index fund based off the S&P 500, the NASDAQ, it will always go up over the long term. So buy it and hold on to it, or a mutual fund that's a mixture of stocks. So not an individual stock, but buy an index fund. It will go up and up and up and up and up. Hold on to it for 20 years, 30 years, 40 years, 50 years, and you'll be a millionaire. And then, so just avoid the mainstream media, because they are getting us to take too much action. So we need to get in the habit of the opposite of that, which is inaction. Inaction is just holding on to it, buying more when you have enough information and education to buy on the 5% drawdown, to buy on the 10% drawdown, to buy on the 20% drawdown, which is like going on right now. So if you like the video, subscribe. Thanks for watching. Smash the like button, and we'll see you in the next video.